Good morning, ladies and gentlemen. Thank you for accepting our invitation to the Prescient Multi-Asset Quarterly Update webinar. I'm Kirsty Jeffries, and I'm going to do the introduction as well as post your questions to Bastian and Rupert towards the end of our session. Today, Bastian and Rupert, Bastian being Head of Asset Allocation and Investment Research, and Rupert's one of the portfolio asset managers, are going to provide us with a market update and outlook covering themes like vaccine inequality, the democratic blue wave, more of the same in 2021, with a focus all being around the Prescient Balance Fund to sum it all up. As a quick reminder, the Prescient Balance Fund aims to provide stability in an uncertain world by delivering small, consistent outperformance, which when compounded provides top decile performance through all time periods. Our fund delivered 8.21% in 2020, while the average multi-asset high equity fund delivered 5.19%. We are positioned in the top decile over all time periods. I really hope that you find value in today's session and welcome receiving any feedback that you feel could help us improve going forward. Before I hand over to the guys, I've got two things I'd like to raise. As with any virtual meeting, please bear with us should we run into any presentation interruptions. We do have backup power, so any load shedding issues will be mitigated very quickly. And then lastly, we have been running through our quarterly updates. Should you be interested in investing in our China funds, Liang is going to be doing a live webinar on Monday, the 1st of February, where he's going to take us through our Prescient China Balance Fund, which has delivered 20% per annum for the past 8 years. If you haven't received the invitation and would like to, please reach out to your regional business development manager, and I'm sure they'll help you with the registration. Thank you so much for your time today. And with that, I'm going to hand you across to Bastian and Rupert. Thank you.
Thanks, Kirsty, and thanks from our side to everybody for joining and just for your time. And we're going to start with a quick performance recap. And I just want to highlight it's not about the final outcome and not about the final performance. It's also more about the pause and the journey, how we got there. So it's all about steady and reliability. So Prescient Balance Fund has beaten its benchmark over all measurement periods, and it has also beaten the peer group, which is basically the blue bar on this slide. It makes us particularly proud that we could beat the peer group by more than 3% in the last year, simply because it was a year which has put a lot of investment processes into a decent test, and we are glad that we passed that test. We're also glad and we're also proud that we could beat our benchmark. And the reason why I'm pronouncing that is because on purpose we chose an ambitious benchmark, a composite benchmark, and you could see that the orange bar is always higher than the blue bar. So the composite benchmark is something which is just incredibly difficult to beat. The composite benchmark beats the high equity category overall measurement periods. So we know if we beat our composite benchmark by a little bit every year, and we are well ahead of target. Okay, well ahead of target is a good point. Our target is not only to beat peers, but to beat peers consistently. And it's all about the steady path and the reliability in terms of relative performance. So what we're showing here is the rolling percentile ranking through time, the blue line being the Prescient Balance Fund and the gray line being all the peers in the category. If a fund is at the top, if the line is right at the top here, you're the #1 fund in the category. If your line is at the bottom, you're the last fund in the category. What we try to highlight here is that for us, it's not about being the #1 fund in the category, but for us, it is about steadily and almost always being in the first quarter. Over 5 years periods, we've never dropped out, but also over shorter periods, we managed to avoid being weaker than the average almost at all times. Just a quick recap how the fund operates and how do we get to this very steady and reliable result. We have 3 very reliable sources of alpha. The first at the top left being a dynamic strategic asset allocation. I want to pronounce the word dynamic here because strategic is long-term, but strategic means that you have to adjust for structural breaks. And we saw quite a few of those breaks in 2020, which required us to adjust our long-term capital market assumptions, and with that to adjust our strategic asset allocation. So I think that's what sets us apart from a pure passive fund. a pure passive balance fund, in our opinion, can never work because it simply means that you never adjust for structural breaks. Your strategic asset allocation is always the same, and that's not good because that's the most defining part of your investment process. The top right, you see systematic tactical asset allocation. So I think systematic is the key word here, simply because we do think when it comes to tactical asset allocation tilts, it's crucial to take out the noise, take out the emotion, and go with the evidence and go with the numbers. Tactical asset allocation approach consistently added alpha to the fund in a very reliable way, but also in a very risk measured way. So all our tilts are driven by 4 factors: value, economics, financial conditions, and sentiment. We never overrule these factors. But what is also important is all the tilts happen within predefined bands and they are strictly risk controlled. At the bottom left, we have our concept of portable alpha. This is where we are actively not engaging in stock picking. We also actively not engage in replicating the index like for like. So what we're doing is we getting fixed income alpha and porting it on equity beta. So what you're achieving then is a very reliable alpha profile, which comes on top of equity beta. So by doing that, we have 7 years of positive equity alpha in a row now. And I'm not meaning the 7-year period. I'm meaning 7 individual years of positive alpha. That's just how reliable this approach is. And then at the bottom right, we can see low fees. So our balance fund has a management fee of just 30 bips. You can see on this chart that our TIC, and this is the x-axis, is amongst the cheapest TICs in the market. And we often hear the argument, yes, you want some passive exposure and it makes sense to bring down your fees, but you don't want to sacrifice a smart active process. So first of all, we do think our fund is smart as well. Secondly, it's also active. And thirdly, what this chart proves is that active management and good performance doesn't necessarily go hand in hand. So you actually have to have low costs to outperform. It's a function of high fees leading to underperformance and not the other way around. Okay, so what are we really trying to achieve? And that's my last slide before I'll quickly hand over to Rupert. We are acknowledging a strong drive for passive investments. Low fees, low transaction costs, low tracking error, those are the elements of a pure passive fund, and we fully understand why so many clients appreciate passive funds. Having said that, there are also very nice elements of the active side. We like the idea of generating within an asset class alpha. We do that though with our portable alpha process. We like the idea of efficient allocation of capital. We do think that you have to adjust your strategic asset allocation once there are structural breaks. And we do like the idea of capturing market dislocations. If the stars align and you have a cheap market, easy financial conditions, turning economic picture, and an improving sentiment, you want to overweight certain asset classes. And I think one should do that. So the combination of all the benefits of passive investments and all the benefits of active investments, that's how we run the Prescient Balance Fund. So clear message here, whether active or passive, doesn't matter. You don't have to sacrifice one for the other. We can give you all the benefits in one solution.
Right, so I'm just going to take us through more a broader outlook on what we see in the world at the moment, how we see the cogs of the world macroeconomy moving, and how that comes into effect in our balanced fund. So I've got 2 charts here. This chart tells the story of the first COVID wave. So this is from the start of January 2020, and it's to the trough of 23rd of March 2020. And this is something we all lived through. It was quite a violent sell-off. These assets are priced in rands, so for offshore assets, you get the rand depreciation as well. What you can see here is the losers were SA equities, SA property. The big winner was DM bonds priced in rands, and then things like DM income, and then simply DM cash. So if you'd parked your money offshore in this scenario, you would have banked quite a bit of performance. But the way to look at this, in our view, is how did the assets climb back out? And this chart rebases again to the 23rd of March. And this is the story that we lived through since the COVID sell-off. So what you can see here is that SA equities and SA bonds were 2 of the strongest performers. SA property wasn't far behind. Also in the top performers was DM equities priced in rands and EM equities. as well as EM small caps. The asset classes that didn't perform terribly well were DM bonds, that's developed markets, income and cash offshore. So that is also a function of the Rand having strengthened all the way back to where it was pre-COVID. But it's just a concept of how do we see the market in terms of 2020 as a whole versus 2020 split up into two regimes, the first being a sell-off and the second being a rebound. Going a bit deeper into COVID. So here we can see the infection growth rate. We showed you this last quarter. This has been updated to the 18th of Jan. So what you can see here is the US has had a couple of waves, and the waves have been a lot more significant than our waves. You can see this is normalized on the y-axis to infection per 100 million of people. And what you can see here is we experienced a wave right in the middle where we all knew we went into level 5 lockdown. That came right off, and then we experienced our second wave, which is subsequently coming off again. Yet to see where that goes from here, but it certainly has helped us to mitigate the second wave having gone into level 3 lockdown again. But I just wanted to go a bit deeper into that number. So this data is from the South African Medical Research Council. They are part of the decision-making team that decides on lockdowns. And what you can see in the top left here, to explain this chart, the red area is the reported COVID deaths. So that corresponds to the previous chart that I showed you. And the blue bar shows excess deaths. So excess deaths are deaths in excess of what is expected in a normal economic or a normal living environment. So you can see a direct correlation between the reported COVID deaths and excess deaths. If you dig deeper into the provinces, you see that that's especially the disconnect is especially large within Eastern Cape, Limpopo and Mpumalanga. And we just think that's an interesting way of looking at this whole scenario as to whether the numbers that we see on a daily basis are a true reflection of what's actually happening on the ground. And one of our worries within South Africa is that, as I say on the slide, things perhaps aren't what they seem. So that's just something that we're keeping in mind, whether the second wave is indeed coming off or whether it is just underreported remains to be seen. But this certainly suggests that in some ways it has been underreported. So vaccine rollouts is the topic on most people's minds for January 2021. We've seen supply chains coming online, particularly in the United States and in the UK. Supply chains came online even earlier in Russia and China for different pharmaceutical companies. But what I wanted to highlight here is that SA or South Africa is actually on this chart. They just haven't had a single percentage of the population vaccinated as yet. So I believe yesterday, the first delivery of vaccines came across from India, but we're just so far behind the curve in terms of vaccine rollouts that is certainly a worry for us going forward into first and second quarter of 2021 for, in particular, things like South African equities. Going a bit further on a holistic basis, vaccine rollouts. So the chart that you can see here is for the United States. It's a large-scale survey of who would take vaccines versus who wouldn't. The firm yeses are 40%. They've got a 41% in the maybe region, which means that people would rather wait and see if there aren't side effects, or they would rather see if it's confident on a longer term basis, and then around 20% say no. Interestingly, in South Africa, we also have around 20% saying no, in other words, like an anti-vaxxer, but we have a much larger percentage of people saying yes. This comes from University of Johannesburg and Human Science Research Council, and interestingly to see that the estimate of critical rollout of vaccinations is around 2/3 of the population, and it seems like in South Africa the population is more than willing to take up that vaccine rollout when it eventually comes to South African shores. So just pulling that back into what that means for asset classes. So this is our systematic model of how we see the world in terms of different asset classes. You can see that in the equity space we're largely neutral. We've been monitoring that space for quite some time. The value case is pretty negative, but the sentiment case, I think we've all experienced that through November, December. Markets have rallied strongly. Investors are piling money into things like emerging markets, which are generally seen as high-risk investments. And the two are essentially offsetting each other to come to a neutral view. What's particularly of interest to us within our balanced funds portfolios are the real assets, where we have overweights, strong overweights in property, pref shares, and ILBs, all of which are offering attractive yield profiles. And we see, in particular, preference shares and ILBs as attractive asset classes which have yet to experience the rebound that we've seen in November, December in the equity space and also in the SA property space. The Rand, we're also pretty bullish on still, simply because the carry yield case is so strong for the Rand that offshore investors are highly attracted to investing in the Rand. And combining that with the strong overweight in South African bonds means that you get a high yield by investing in Rands as a dollar investor in South Africa. So I'm just going to go through a theme or two of what we're seeing in a bit more depth. The one theme is, are markets outpacing growth? That's a theme that we've seen for the past 5 years or so, and particularly exacerbated in 2020 when growth fell off a cliff and markets seemed to just keep on rallying. So is that going to continue? What we've seen is a massive injection of monetary stimulus coming from the Fed. You can see on the far right, it's picked up to levels of magnitude which are much higher than the 2008 quantitative easing schemes. And if you dig into what that means as a story, essentially this to me is a crisis playbook. So this chart is a dissection of what the previous chart showed, or these three charts. What you see, the first wave is that you get central bank liquidity swaps. That's across the globe in order to provide liquidity in a crisis, and then also loans for commercial banks within the US economy. And then second wave, you get nominal notes and bonds as a buyback program for the central bank. And then interestingly for us, the third wave, which came around about May, was corporate credit facilities. So that's issuing credit facilities to US corporates, which backs up the US corporate equity market as well. So putting that in context, so what I've said here is when it pays to pay away, literally you are paying away to in this case, in negative yielding bonds, you're paying away for holding the bond. And at the same time, those bonds have rallied quite drastically. So you've got capital appreciation on negative yielding bonds. And that's the weird world that we're currently living in and what we're having to deal with in the multi-asset space. So how does that look in terms of a traditional mean variance efficient frontier? So here we've got the returns or asset yields on the y-axis, and the volatility, which is a proxy for risk, on the x-axis. And this is pre-COVID. So here you've got long-term return assumptions, which are pre-COVID. Looks pretty normal. A balanced fund, a normal balanced fund would have a volatility of around 8% with this efficient frontier. But what's interesting is if we overlay what happens when you decrease those long-term risk premia in order to decrease the asset classes as a whole. So what happens now is the asset classes themselves have moved down in terms of expected yields or returns, and they have maintained roughly the same volatility. For a multi-asset fund, what that means is that you've had to shift along the efficient frontier to take more risk in order to achieve the same return targets. And this also highlights how some of the long-term return assumptions on these asset classes are now giving us negative real yields. Doesn't mean those assets aren't included within a multi-asset portfolio. Sometimes the negative correlations offset the negative real yields that you might get, but it's just an interesting new picture of multi-asset portfolios that I found interesting to show you today. So how does that tie back into our multi-asset portfolios? Basically, that means that in our strategic asset allocations, you're seeing central bank liquidity numbers coming through, long-term market pricing on the 30-year swaps, for things like inflation assumptions, etc. And then what happens for us within Prescient is that's debated within the investment team, and we see whether changes are structural. And if they are indeed structural, then we will change our long-term return assumptions and then re-optimize the portfolios, as Bastian mentioned a little bit earlier, and the portfolio foundations are adjusted. What happened in the last year is they were adjusted, but only minimally. We found that the actual changes in long-term assumptions were not as drastic as some people might think, but we do have that ability, which we find is very important versus a pure passive alternative.
Yeah. So I think at this point also worth mentioning that, I mean, Rupert spoke a lot about financial conditions being very easy and COVID hitting the world hard. And what is not covered in our slide, but obviously equally, if not more important, is one of very negative side effects, which is the rise in inequality. So obviously, as a wealthy human being, you are able to fully participate in your recovery. You're able to now even look at markets reaching all-time highs. But if you are on the other side of the equation, you might still realize that the job loss is permanent because the actual real economy has not recovered. So inequality, one of the bigger themes which bothers us a lot at Prescient and which we're looking into closely. And speaking about a vaccine rollout is actually something positive, but unfortunately we must say, and that's a theme which we're also monitoring closely, that even when it comes to the vaccine, life is not fair to everybody, and that's obviously very bad. And it's just one of the themes which we are covering, which is a potential risk retreat to developed markets, which is, to be very clear, not our base case. We also like emerging markets more than developed markets right now, but it's important to highlight that because it kind of feels like becoming consensus that the developed world is very overpriced and the emerging markets are often cheap. And we want to show some contrarian slides to this mainstream view, if I might call it like that. So what you can see here on this chart on the x-axis is the vaccine pipeline per capita. So basically how many vaccinations are secured in each and every individual country per person living in that country. And on the y-axis, we have the GDP per capita, so the simple purchasing power of the individual countries. And what you can see, unfortunately, there is a straight correlation between the vaccine pipeline and GDP per capita. So yeah, one is playing with human lives here in the way that who has more cash can buy more vaccines, and that's obviously very sad. And if we see where we are in South Africa, obviously we are on the bottom left because we are an emerging market, and you can see that our purchasing power is not in line with other developed markets. So another theme to highlight this and to completely coming from a different direction now, but also what to look at when it comes to emerging markets, to developed markets. The often made misconception is that the US market is super expensive and it's all tech driven, and we are seeing the same thing like in the 2000 tech bubble. It's partly true, and we see a lot of parallels as well. But what is different this time is if you retreat to emerging markets, you're not getting a commodity driven industrial market anymore. So if you look at the MSCI emerging market, three out of the four largest constituents in that index are heavily tech driven. It's Tencent, it's Samsung, it's Taiwan Semiconductor. So it's very, very similar to actually the developed market world indices. And a function of that is the result of that is obviously that we also see highly elevated PE ratios. So just to have a little bit of a contrarian view in these slides as well, what we measure carefully as one of our value indicators is the relative earnings yield. So the earnings yield is just the inversion of the PE ratio. And then we are basically looking at long-term real return expectations. So now we're taking emerging market return expectations or real yield expectations on equities minus developed markets. And you can see that line is almost, other than short period in 2007, that number is always positive. Why? Because you're taking more risks in emerging markets, meaning that you are looking at a risk premium here for emerging markets. So the earnings yield must be higher than zero in emerging, then the gap here must be higher than zero. So the earnings yield in emerging market must be higher than developed markets. But you can see that we've dropped below the long-term average quite significantly. So on a relative basis, emerging markets are not necessarily cheaper than emerging markets. On a pure relative basis, they have actually already catched up, and they are similar indications of bubbles in the emerging markets as we see them in the developed markets, at least if we look at the equity space. The story is very, very different if we look at our bond market or real assets. Okay, so in terms of tactical asset allocation, just to sum up also what I said on the slides before, we see the relative value case diminished between EM and DM, so that's not one of the reasons why we would like emerging markets. It's not a value case, it's not a value story. What could happen is sentiment turns negative again on emerging markets. I'm just citing, for example, the trade war could fuel up again. I think even if we are, like the base case is if we get through this, if we get through the whole pandemic, hopefully faster than anticipated, that will lead to a big risk on trade and emerging markets with a traditionally higher beta outperforming. Okay, so that's the base case, and we also think that's going to happen. But what if not? So what if we're wrong on this one? What if we see prolonged trade wars from the Biden administration against China, for example? We will have significant setbacks in emerging markets and probably more so than in developed markets. Okay, and financial conditions being a commodity, and that's the third point on our slide. We are so used to easy financial conditions, like unlimited fiscal support, unlimited support by the Fed, that it's almost impossible for us to think that this is ever going to go away. And we had the Fed speaking day before yesterday, and they made it sound again that it's not going to go away. But again, we're saying what if, and what if, and if it does happen, tighter financial conditions would clearly lead to underperformance of emerging markets. Or what if financial conditions tighten more so in the more developed emerging markets, for example, like in China? So there are reasons to be concerned about emerging markets as well, and we thought it would make sense to basically also highlight them within this presentation.
Yeah, so just following on from that, what we're seeing in South Africa is almost a pretty boring situation politically. So we thought we'd carry this back to developed markets and see with the democratic blue wave, in other words, the House, the Senate, and the presidency being now democratic in the United States, what does that mean for markets? Does that mean that there's a reversal of my first trend that I talked about, where markets have outpaced growth? Is growth now going to outpace markets? And what does that mean for markets? What are we looking at for the next couple of years? So just to go into what it's meant historically. So interestingly, for the markets, the global markets, the most productive environment has been a split Congress, meaning the House of Representatives and the Senate, which I guess I'm not going to really dig much into that. I mean, I guess it's probably arguments cause positive things for equity markets, but what I'm focusing on here is in particular GDP growth, and that's where it's been the lowest. So GDP growth generally fueled by policies within the government, and when there's a split government, it's very hard to pass any sort of legislation to have big hitting policies. We saw that type of environment in the early days of the Obama presidency, where there was a triple democratic blue wave. What we're seeing now again is a similar thing within the Biden presidency, and what effect is that going to have on markets? In terms of what it looks like from a democratic perspective, you do in general get the highest level of GDP growth. Again, this is with the proviso that past performance doesn't lead to future results, but it is just a type of a theme that we like to look into. So why might that be? So a couple of just small points on what it means to have a democratic leadership. So they've promised within their campaign trail they're going to raise the minimum wage. They're going to increase public health care. I believe it was yesterday that Biden brought back Obamacare, and with an aggressive approach to COVID. At the same time, they're looking at increasing taxes, and this is the most important for us for capital markets. For corporate companies, you've got an increase from 21% to 28%. Simply put, that dilutes the earnings. So what that could lead to is a further inflation of the PE ratio, with earnings coming in even more. So that's slightly worrying for developed markets. Then you've got a theme if you're playing thematic trades of clean energy over fossil fuels. That's something that we expect to see as a theme going in the medium to long term as well, where unless things like Shell and BP reinvent themselves, I don't think they're going to have much of a use case going forward. And as Bastian mentioned earlier, you've seen a domination of tech firms also within the S&P 500. Compare that to the 1990s when it was the likes of Chevron, BP, Shell, etc. So it's a very different environment that we're looking into. Foreign policy is the last point. There is a more accommodative foreign policy for South Africa, so that is a stimulus point for South Africa. We definitely prefer a triple democratic policy, and for other emerging markets. But China is uncertain. So Joe Biden has come out and he said the China question remains open. They are not happy with China. So whether the trade wars reignite is another thing to look out for. I don't think they would be of the magnitude or perhaps the level of aggression that we had during the Trump era, but there is definitely a risk that the China trade wars do reignite going forward. So also Bastian talked about monetary policy, monetary stimulus in the United States. How effective is that? And we have had commentary from the US Fed saying, listen, we're trying to do all we can to reignite this economy, the flame of the economy, but fiscal stimulus is even more important, much more important than it's been historically. So here you've got GDP growth minus inflation, essentially real GDP growth. And you could argue that monetary stimulus leads to inflation by throwing money at the problem. You are devaluing the dollar in a way. But is that effective? I mean, it isn't as effective as it once was. What the US economy generally does is they throw money at the problem and the growth exceeds inflation and they grow out of that economic trough. Whether that is effective this time around is I think, to be debated, and that's something that we're looking out for. Fiscal stimulus is the way to go, and fiscal stimulus encourages more of a growth case than a simple market case with throwing money at the problem. So coming back to our portfolios, mixed bag in this case. So increased tax burden decreases corporate earnings. That brings down the PE ratio and the likes, and that's a negative for value. At least puts up the PE ratio, brings down the earnings, negative for value. And the other side of the coin is that policy certainty would lift market sentiment. We've seen that coming through into January. And then you've got global growth, but that's so in essence that's positive for the medium to long term for the economy. It's something that we've essentially needed for quite some time, but it's at the expense of the short-term capital markets. So you could see negative runs on the equity markets and until the medium to long term when the growth case starts to lift them up from the earnings perspective once again. So again, as Bastian said, this isn't the case right now, but it's something that we are looking into the future for. And our portfolios track all of these metrics. And we believe that if any of these situations do change, the portfolios would adjust in time to pick up these new normals within the world.
I think the message is a lot of uncertainty, and it will not be less uncertainty in 2021 than it has been in 2020, and we have to be equipped for that. And we are just so convinced that having a systematic and unbiased approach to things is really the way to go. We have in 2020 once again had a positive contribution to our returns, to our alpha profile from our strategic asset allocation, which Rupert has covered in the beginning. We also have a positive contribution from our tactical asset allocation tilts through this systematic approach, which is interesting because we often get this question like, I mean, how can your systematic approach take into account something like COVID or like a pandemic, or can you foresee that? Well, clearly we can't foresee a pandemic, and I think everybody who claims that he could foresee that is well, he must explain that to me how he got that one right. I don't think that's the case, but a systematic approach can be designed in a very robust way so that it can succeed in all market cycles. And I think succeeding in all market cycles, that's also the theme for our within asset class alpha generation approach. So as you know, we do not stock pick. So we just don't believe that it's a winner's game, simply because the numbers are not on your side, and we've seen it. I mean, we've observed it over so many years, and I mean, it doesn't matter how far you go back. The hit rate of active managers beating the benchmark is 20% or lower. And on top of that, it's impossible to find them because there's absolutely no correlation between strong performance last year and who's going to be the strong performer next year. So without speaking about individual managers, we just don't like this approach. We are trying to compete and participate in what we wouldn't call a loser's game, but a winner's game. And that's the fixed income side of things. So on the fixed income side, you will see that most fixed income managers do beat the benchmark, and the odds are completely switched around. Now you've got 80% of fixed income managers actually beating the market, and we do pride ourselves at Prescient to being particularly good on the fixed income side. And why not utilize it? So how do you utilize it? How do you solve this conundrum? So you have to have 65% equities in a high equity balance fund to get a CPI plus 6. So we can have the best and smartest fixed income approach in the world. We will not get to CPI plus 6. It's just impossible. So you will need this high allocation to equities. So how do we solve this? How do we get this very reliable fixed income alpha and get it on this high returning equity beta? So that's the sweet spot, and that's where you want to be. And the way we're doing it is by using futures. And it's, again, if you speak about futures or derivatives, people often get frightened, but there's just so many reasons why using simply futures in a long only approach is actually far more safe than using a full replication or even stock picking approach. We don't engage. I mean, regulation would never allow us to do any gearing. That can never happen. We never exposed to any counterparty risk. That's all only with the exchange. The tracking error is minimal. The basis risk is almost non-existent. So liquidity is much higher than in the cash market. So we literally see almost only benefits. The nice thing about using futures, you get a very, very efficient, low cost and clean equity beta, which is exactly what we want. And the first line on the slide basically speaks to no arbitrage pricing. So for that, we must all go back to first semester at university, where you learn that if you take a future and put your money in the bank account, you have to get the market return. There's no way around this. Otherwise, if it would be higher, everybody would be doing this, and then the cash market would return less and would become more attractive. Otherwise, if cash and futures would be giving you a lower return, you could just buy the market and arbitrage it by selling futures against it. So cash and futures must give you the market return. So if that's the case, and we are good in fixed income, so why don't we do, instead of cash plus futures, why don't we do income assets with futures? Simply because by doing that, we will get cash plus alpha in a very reliable way, plus equity beta. And that's the bottom right box at the top of the slide. We get equity beta, but fixed income alpha. And that's exactly what you want. And it's coming through nicely in those individual lines, which you can see at the bottom of the slide. So we plotted the individual years and the 260 trading days throughout those individual years. And every single year, our portable alpha has taken us into positive territory. And yeah, I don't want to overstate things, but in 2020, when we had COVID hit, I mean, liquidity on the futures was as good as any other day, if not better. Fixed income assets being so conservative did not move. So you will not even pick up any added standard deviation in this profile. I can just highlight by looking at the y-axis how steady and conservative our alpha contribution here is. And yeah, I think that speaks to a maybe more boring equity approach. We don't have smart stories about individual shares, but we have a positive alpha every year. And I always like to say that in 2015, we had the strongest alpha year, which was just above 60 basis points in alpha. And if we speak to an equity manager and he would ask us, what has been your most positive equity year within your alpha process? What's the biggest alpha you've ever generated? And I'll say 60 basis points, and he will probably laugh at us. But if we take it one step further, and then we would ask in return, well, what has been the most negative return in your alpha profile since you in the market? And we would say, well, for us, even the most negative year we ever had, which was 2018, we still had a positive alpha contribution. And I think that speaks to our story that slow and steady really wins the race, and that we are not in to shoot the lights out. lights out, but we are in for consistency and beating our peers every single year by a little bit, not because we are unambitious and only want to be better than average, more so because we understand the power of compounding, and we do know that if you beat your peers on average by a few basis points every single year, you go to the top over periods of 3 years or 5 years anyway, and that's where we want to be, and that's exactly what's materializing in the fund. So just to recap, a systematic approach to investing, we do think that periods of uncertainty and periods of unforeseen crisis like COVID-19 are not a problem to a systematic approach. It's not a period where a systematic approach doesn't work. It is a period where the systematic approach works particularly well because we do not have human biases. And at the same point in time, we are also humbled by the markets every day, and we do understand that not everything in our process is perfect. So we have room to use these experiences to enhance and improve the processes in a very sober way, and we don't have to get emotional because we just follow our models. And so we do produce stable and predicted outcomes. So I mentioned earlier that on the slide before, actually, that our portable alphas process is about stability and that it contributes positively by a little bit every single year. And that's what we're in for. We have outperformance of our peers. So we actually have 3 reasons now, as we think, to beat a pure passive, and we know the pure passives beat the pure active funds, but we think we've got 3 good reasons to understand why we should be beating pure passive funds even. We've got this dynamic strategic asset allocation, which our peers do not have. We've got a dynamic tactical asset allocation, which a pure passive fund does not have. And we're doing portable alpha on top of our asset classes every single year, which a pure passive fund again would not do. And the best thing about this approach is, I'm not sure if it's the best, but one of the very good benefits of this approach is also the last point of this slide, the scalability, which we happily give back to our clients. So we can run the fund at extraordinarily low costs, not because we do not like to take fees, but simply because we are more efficient in terms of not needing a lot of analysts speaking to corporates. That just doesn't add value. We don't do it. So we are more efficient. We can process millions and millions of data points every single day with a much smaller team. And I am 100% convinced, and I can say with full confidence, that we are extracting more information with this team than any active stock picking team would ever extract. Okay, so this is just a quick summary of the 3 building blocks and whether the alpha contribution over the initial years, the fund was launched in 2013, whether the alpha contribution has been positive in the individual calendar years. So SAA, you can see 2 neutrals, 2014 to 2016. That was basically when our strategic asset allocation framework was not fully applied within this fund, simply because it wasn't sufficiently refined. We've worked very, very hard because we do think that the strategic asset allocation is just key. And then in 2017, we added it as the dynamic optimization of our strategic asset allocation as a part of our alpha process. Since then, 3 out of 4 times it has contributed positively. Then a systematic model-driven tactical asset allocation process, does that add alpha? Well, at least over the last 7 years, 6 out of 7 times it has added alpha. I mean, one must be realistic that tactical asset allocation, even if you do it with a lot of data points and in a very systematic and disciplined way, it's not a free lunch. So you have to do it risk controlled and very cautiously. But if you do it and if you diversify your bets and you have enough bets and you have those bets on high conviction, I do think that a hit ratio of 6 out of 7 is something, and I mean the fund has proven it, is something which is actually doable. But yeah, it requires a lot of work and a lot of effort to get there. And last but not least, portable alpha, maybe the most boring part of our process, maybe not the most exciting story, because we literally will not speak about any insightful single stock story in our presentation. But yeah, the portable alpha has worked for us every single year. We got a positive contribution, and we do not expect that to be different in 2021. Okay, just a recap, we've seen that slide before, but we've got 3 good reasons why we get a little bit of alpha every single year. That leads to the consistency, and I can just highlight on this slide, look at 2020 2020, so March 2020, how those gray lines start to move aggressively. So that's all the dispersion, because now you get the stock pickers picking the right shares, picking the wrong shares. You see guys making aggressive tilts in their tactical asset allocation, trying to pick peaks and time troughs, and all of that leads to a massive reshuffling of your peer relative ranking. A lot of guys got it spot on right, a lot of guys got it spot on wrong. How did we fare? Well, for us, we did what we always do. We added a few basis points of alpha, beat our peer group, and that's why we stayed up there in a very, very steady and consistent way. And not just during the crash of COVID, we stayed up there, even after the recovery. We captured the recovery as well. So just a more humble and less bold approach, which just works through time. And I think the stats, I mean, I don't want to speak about performance much more, but this is our last statistic on performance, which is, again, it's for me not about the final outcome. It's more about the path which we got there and the track. And what you can see on this chart is basically just the historic the number of observations, or the percentage number of observations, how often the fund spends against peers in a certain quartile ranking. And you can see that on a 1 year period already, there's a red part in this column which doesn't even feature. So on a 1 year basis, we've never ever, and you can go back all the 7 years and look at rolling returns on a daily or monthly basis, you name it. On a 1 year rolling basis, we have never ever drifted into the last quarter, and I don't anticipate that it would happen. And on a 1 year basis, you can see that 90% of the time, I think it's 88 to be precise, 88% of the time, we are actually in the first or second quartile. So that's exactly where we want to be, because you look at the second bar and you can see that over a 3 year period, basically just dropped out of the, we've just dropped out of the first quartile for one single month, if you really measure every single month on a rolling basis. And on the 5 year number, that's the chart we showed before, we never dropped out. And yeah, we do think that this process and this fund is well equipped to just stay up there for the future. Okay, so just a quick recap, and this is basically our last slide to just sum up. So what we're trying to achieve in this fund, and what we have achieved over the last 7 years, is really a combination of all the benefits of a pure passive fund, and combining these benefits with basically all the attractive and nice elements of a pure active fund. So what you get is, you name it, but it is actually an active fund which still has low fees, low transaction costs, and a low tracking error. And as said, it's all about consistency, and we just want to highlight, don't feel forced to come to a difficult decision, how much must be active, how much must be passive. There is a way to combine these benefits in one solution. So yeah, that's basically us. Obviously, we are open for questions if there are any points unanswered.
Thank you so much. I've got a few questions that have come through. I'm going to try and group them so that you can answer one question as opposed to four that relate to the same topic. So in one of the slides, you almost illustrated that the developed markets would return to a more fully productive, economic cycle more quickly than emerging markets would. I just wanted to clarify that for some people. And then on the back of that, with those developed markets having booked or bought far more vaccine doses than their population actually requires, do you foresee that they would seek to sell the excess off to emerging market countries, South Africa being one of those? And then on the back of that question, what do you think the risks are of a third wave for COVID in South Africa, or for further waves in the US and UK?
Yeah, so good questions. I think all linked, as you say. I think starting the last one, I think the risks are pretty much known and on the table. I think that a third wave is a given. If it's not perhaps as sharp as the last time, it will be a resurgence of COVID-19, as one of my slides showed. The question is, have we even gotten over the second wave yet? Not quite sure if that is the case. On the DM versus EM question, I think that's exactly what we're showing on the relative value of EM versus DM. It is something which we are keeping an eye on as to whether they start selling the vaccines. That's a very high possibility. This is a capitalist world, so I see Canada's got 500% of their population vaccinated. So I think a lot of people have been asking, are they stockpiling in order to sell them on again? And that is certainly something which they could be doing in future. I think just to remind everyone, on the current vaccines, you need 2 doses. So if you're 200% vaccinated, essentially that means that you have vaccinated your entire economy. For us in South Africa, in COVAX, we first got 10% promised to us, and we've since added a couple more via other routes, but we certainly are very far from the 200%. Whether that is necessary is up for debate. South Africa seems to be pretty robust in terms of COVID numbers, certainly according to the official numbers. And a lot of people have perhaps had COVID. So in essence, that gives you an embedded vaccine, only for a while, but it could help us in terms of suppressing a third wave going further. DM versus EM, I think we've covered that in part in that it could emerge that developed markets become more attractive than emerging markets. I think that the question is whether the growth case will emerge again. The only way to get out of the current market situation for both EM and DM is to grow your way out of it. And I think that's something that we're keeping as a firm eye on.
I just also want to add to the second question, so whether the vaccinations are sold. So I'm going to take a more European, maybe more optimistic stance than Rupert here. So Norway has actually pledged to donate all the oversupply which they bought into the COVAX facility. So that's obviously the way which we hope the route that developed markets go. I mean, selling them on speculation with these vaccines, especially if one looks at Canada, we can only hope that this will not materialize and that there will be a little bit of donation rather of the excess supply. But yeah, I mean, future will tell.
Thank you. I think these 2 questions perhaps come from our multi-asset monthly commentary, but I've got a question here pertaining to SA property. So overweight seems at odds with vacancies in retail and office space. What particular property companies do you favour if we have an overweight position there? And then the second one pertains to, you have an overweight position on the Rand. What are the risks to this position at the moment?
Sure. So on the property case, so we take exposure to the index rather than to individual counters. So we diversify across the names. We have been monitoring the property earnings yield, and that has come right back down to the long-term average. So the value case on property has largely disappeared. That was over November and December. Very profitable trade for us that we held through that period. What does remain supportive, though, our financial conditions, and as I mentioned, sentiment has picked up to support the property case. So what that is implying is that through a positive sentiment case, you could see more consumers coming back into the property market to start picking up rentals, reducing those vacancy rates. Similarly, in the commercial space, if business sentiment has picked up, like we've seen, then you could start to see businesses coming back online. There is definitely a risk to that, and we monitor that continuously going forward.
I think also to add to that, there's a lot of risks to the asset class listed property, and we track it closely. So if we have a high conviction overweight on an asset class as volatile as listed property, it's a 3% tilt, which we do think we can easily stomach if it goes the wrong way. So yeah, we really look at it from a macro level, and that's also why we don't favor certain counters. So again, we don't really, like, especially listed property feels like it's something tangible. You can actually beat the market by having a little bit more information, but the reality is the odds once again don't show it. So the average property fund is also struggling to beat the index. So what we're doing is, once again, we get synthetic exposure and we apply our portable alpha process. So what we're getting is the property index return plus a little bit of extra, which comes through in a very, very reliable way. So exactly as on the equity side, we would not pick property counters, but we have a very detailed view on the asset class, but then we would add portable alpha. think we also want to cover the rand in this question. So, what are the risks to the rand? So, the rand is, as we think, still undervalued from a pure purchasing power parity point of view. We also do think that the very wide interest rate differential at the back end of the curve is in favor of the rand. All of that, however, was in place already and we've still seen levels which went to, and the rand went to like 19 and beyond. So it's a very volatile currency, and one can always be on the wrong side of the trade. I think biggest risks for us are right now less so local factors, but more like the global sentiment. So one of the reasons why we are positive on the rand is really this turn in global sentiment towards higher commodity prices, the hunt for yield, the drive into higher yielding currencies and bonds, and that's what we really think makes the asset class benefit. So I'm actually going as far as like, whenever did you have a period of a rand being massively undervalued, an economy which has tanked but is about to turn around, a sentiment which was at all-time lows but is recovering, and financial conditions across the globe more supportive than they've ever been before. So that's just the bird's eye view on how we see the currencies. There is a risk to that view also. I would cite local risks to some extent. I mean, the fiscal situation obviously is concerning us a lot. We are capturing that in our financial condition models as well. So saying if it wouldn't be for the fiscal situation, we would be even more positive on the rand. But even including the fiscal situation and the fiscal cliff which we are facing, we are still strongly positive on the rand. But yes, clearly there are a lot of risks, and we're not going to say that this is a risk-free trade.
Thanks very much. I don't think we're going to have time to necessarily cover all the questions, but I do have another one here just from an asset allocation point of view. Somebody's asked, are you negative on emerging market asset classes, given what you have said through our presentation, because many of our competitors seem optimistic?
Right. I think that's, yeah, so to go back to our models in general, what we use is value as one of the factors, and we showed you how the value case has disappeared, both through price appreciation and then the fall off the cliff of earnings through the last year within emerging markets, as well as developed markets. But our other factors, namely economics, financial conditions, and sentiment, are equally as important as value. So for us, that's the broader picture. We often get questions like this where, I mean, property was the one last year. You know, how can you be bullish on property given the current environment? And I think that's something that speaks towards our process, where we try to look at the entire environment rather than selective parts of it. And for us, we're seeing very supportive conditions across economic picture, financial conditions, as Bastian covered, and then positive sentiment. So no matter, I mean, behavioral finance, no matter how expensive the market is, if there's still a willing buyer, the price will go up. It gets very, very scary, but the sentiment is positive, and we see that as a positive for markets going forward. That, however, just as a proviso, does change very quickly. So our models capture that. It's day on day. So if sentiment were to change, in particular investor sentiment, then we capture that day on day, and our models will switch around.
Thank you very much. I think we've reached the end of our time. If there are any other questions that we haven't gotten to, we'll make sure to respond to you on email. Thank you to everybody for taking the time to listen to us today. We will be sharing a recording of this presentation, so that link will be sent to you next week in a thank you email. And if you'd like to have these slides for your records, again, please contact your regional BDM and they will gladly send it through. Thank you so much.
Thank you very much for your time.
Thank you.
Cheers.